So we are recording. If you are hearing me, just let me know that you're hearing me so we can proceed. You can just unmute yourself and say, yes, you're hearing me.
Yes.
All right, good. So,
Karen.
all right. So tonight we're looking, tonight's indicator, as I made mention earlier, it's using the MACD. It's not a very long presentation. It's not a long presentation. Let me just bring that up. All right, so tell me, are you seeing my screen? What is the MACD indicator? Are you seeing my screen?
Yes.
All right, good. Okay. So the thing about it, there are a lot of indicators that we can use, we can implement. But the way those things that we are presenting the lessons, those things are layered. So when you understand how one function, the others become much clearer and it makes a lot more sense. So at the end, you realize there are some indicators that are a combination of some of the other indicators. Because we had the EMA, the exponential moving average, we've done that. We've done the SMA, the simple moving average. So we understand what moving average is all about. Moving average really just takes the average of the last set of candles that we specify by numbers. So moving average of 50 would means we are looking at the average of the last 50 candles, which is going to be kind of old data as compared to doing the moving average of, let's say, the last 14 candles in that light. So bigger the numbers are for the moving averages, it means that we're going to have data that are much older. So we also have to realize, based on the style of trading, if we are doing trading, you want to hold a trade for a week, for a month, and so months, you need to be informed with more data as opposed to if you're just trading on the hour or 2 hours, then you need to make adjustments as to the kind of moving average that you use, right? So the MACD indicator, what is the MACD indicator? So in the Forex market, one of the best tools that technical analysis has for trend identification is the MACD indicator. Again, if at any time, I wouldn't mind if you pause, maybe to ask a question, or if I'm going too fast, say, well, I didn't quite grasp that. So now is the time we can work with it rather than just having to go and look over the videos, which are going to be posted anyways, but we can gain some explanation and we can work together here if we are more interactive. So again, it is a trend identification indicator. So one, it identifies the trend. Two, it tells you if we should stay in that trend, or it tells you when that trend changes. So it's really all about trend. The MACD is about trend. And MACD stands for moving average convergence divergence. I'm going to explain that shortly. It was created by a technical analysis named Gerald Appel from the 70s. It helps you figure out which trend the price is in. It also helps you identify when the trend ends, when it reverses, or when a new trend is created. So this is an indicator that helps you figure out which trend the price is in. So right now we can look at a MACD indicator and know we're in that particular trend. And then it helps us to identify when a trend ends, which means another trend is going to start, or when there's going to be a reversal of the trend, or a new one is created. So it has to do with two things. Moving averages. Remember, the moving average takes into account our price is moving constantly. We are going to take the average of a number of candles. So a moving average of 10 means we're going to see the average price of the last 10 candles at where they close. The moving average of 40 is going to take the average of the last 40 candles together. So we're looking at moving average. So that's what the moving average aspect of it. Then we talk about convergence and divergence. Converge to get together, to follow a pattern, to do that here. Divergence in that sense here means the opposite, going against what it is supposed to. In other words, if I say, okay, I want you to work with me, both of us. When I jump, I want you to point up, right? When I stoop down, I want you to point down. So every time I jump, you are pointing up, we are working together. So your hand shows convergence to what I'm doing because we are going in the same direction. If it so happens that when I jump, you start pointing down for when I'm stooping down, then we are in divergence. In other words, we are going opposite. So one is not working in sync with the other. So basically, moving average, the MACD is a moving average, and we are looking to see how the moving average, if they are going together with the direction of price converging, or if they are going away or opposite from the direction price is heading, then we know they are diverging. In a simple sense, this is what the moving average or the MACD is all about. Again, it is moving averages we're looking at, but we are looking at them in relation to the values, whether they're going along convergence or whether they're going opposite direction, divergence. So let's move. The MACD indicator. So the MACD indicator has the MACD line, which is that blue line, which shows our moving average. We have two moving averages there, 12 and 26. And we have a signal line, the yellow line or orange, as it may appear sometime on your screen here, has a moving average of 9. So let's go again and let's break that down to understand. The MACD line has that moving average, two moving averages together, 12 and 26. So the average of two values here in the blue line, and then we have a signal line. Remember, the bigger the number is for our moving average, the more candles, the more history is incorporated into what the price is. Our moving average, so our moving average of 50 says, let's just say, if you see my mouse, so I'm talking about from that red candle here. Let's say that's a 1 hour chart we're looking at. So we go 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17, 18, 19, 20, 21, 22, 23, 24, 25, 26. So let's suppose price is here, and I say I want to see, okay, the moving average of 26. It means it is going to give me the average of all these candles here. The closing price, and you're going to give me the average here. But that's over a day old. As opposed to, I want to put in a trade now. Here, let's see what's happening. If I take a moving average of 5, it's simply going to take 1, 2, 3, 4, 5. Give me these last 5 candles here, the average of these 5 candles. So that smaller number is going to be more current with what is happening. Over here, if it has to take into consideration all these candles here, let me go back. Previous. Right. If it has to take into account all, come on, stop playing with me, stop playing with me. Right. If it has to take into account all these candles over here, the data it gives us would not be so relevant for now. So that's why we have very short reference here, 12 and 26. So price here is very, very current. But here's what, even what is more current is our signal line. It takes into account 9, a length of 9. So whereas the MACD line, the blue line, incorporates these two, 12 and 26 here, that blue line here, we have the signal line 9. We can see that it's above it here. So it is even closer to price. So MACD is really a real-time indicator. It's not so much of a lagging indicator as some of the other indicators. It is more real-time and up-to-date. Why? Because of the values of the moving average that is being used. So the parts of the MACD indicator, we have the MACD line blue, we have our signal line, and we have two sets of histogram. We have red histogram and we have green histogram. Looking at this, we can see that Whenever the red histogram appears, it is because the price is going downwards. When we have a green histogram, the price is moving slightly upwards. However, it's not just red and green, but there are different shades. Based on the intensity of the shade, you know the move is very significant. So look over here. Look at how these red ones are faded. Look, we're moving to consolidation. It got heavier here when we have these bigger moves. Look here again. In this area here, we have some little consolidation taking place, but still it's more or less another downward. But when we start having this heavy downward trend, we start seeing the color getting heavier. So the components of the MACD again is the MACD line, 12 and 26 moving average, and the signal line with a 9 moving average. And we have our histogram. This 0 line here is a line that is drawn where the histogram can be above it or below it. So that's our 0 line. And further away from the 0 means longer movements, both in the sell or in the buy. But we see those heavier movements when we look at the intensity of the color. And when there is a 0 line here, we see some things happening. Straight away, we can look at this chart here and we can see some things happening here. We have these, the MACD line and the signal line, they cross at times. We have a cross here, or we have them separated here, they're wide open, but here they come close together. But even if they're close right here, they just touch each other, but there was no crossing. They expanded, they opened a bit, they got closer here with a wide opening, but right here, there was a cross. So we have the signal line crossing our MACD line. Again, they're separated, they went close together here, but then again here now, they cross. Just observe it for a while. We're coming down all the time, we're in red, we're in red, we're in red. When we see here, we have a cross taking place, we see the color start changing into green, we do that here. We see there is also another cross taking place, and we start seeing things are happening here. We'll get into that shortly. The MACD indicator consists of 3 main elements. The line, which is dark blue, it is the combination of the EMA 12 and EMA 26, which shows the price development trend, which we spoke about. The signal line, the orange line, that is at EMA 9, it is used to track the price trend. And the third component is the histogram column. This is for measuring the degree of convergence or divergence between 2 moving averages. It shows whether the speed of price change at the given time is fast or slow. Let's go back and let's see something here. So it shows that whether the speed of price is fast or slow. So let's look at the chart again here. Let's look here. Look how short these bars are. And we can see straight out here, the price isn't moving. It's not so big, so much big movements that are taking place. But when we start seeing some big movements like here, we see the bars start lengthening. Same thing happen over here. The bars start lengthening. And when the bars start lengthening, the colors start getting deeper or darker. We're going to see. Right. So a histogram is for measuring the degree of convergence, whether they're relating positively or divergence, they're relating negatively. So now that we understand the components of the MACD, now it's a simple indicator. How to use the MACD indicator in your technical analysis. Strategy 1. We do the trend prediction using the MACD. This is the convergence characteristic of the MACD indicator. It means that the direction of the MACD is the direction of price. Remember I said when I jump, you point up, we are walking together, right? We are in convergence, we are walking together. If when I jump up, you're pointing down, we are away from each other, we are not synchronizing, so we are in divergence. So for the convergent characteristic of the MACD, it means that the direction of the MACD is the direction of the price. You see that here. Remember, our MACD really is our line, right? So don't mix it up here. The MACD aspect of this indicator is the line. When we see what's happening here, look, we have a cross taking place right here. And we have the MACD going upwards. And look at the trend. The trend is a bullish trend. It's an upwards trend. Then we have a downward trend here. And look what's happening. The MACD is going downwards. So once we have the MACD showing, moving in the direction of price, this is when we have convergence taking place. So we're using it as our convergence indicator, right? So the convergent characteristic of the MACD is when the MACD moves in the direction of price. So this is the first characteristic that shows convergence. When the MACD line crosses the signal line from below, when that yellow line or the orange line crosses that blue line from below, or the blue line intersects the orange line from the bottom, the price is trending up and the histogram columns would point up. When the MACD line crosses the signal line from above, that is the blue line intersects the orange line from the top, the price is trending down and the histogram column will head down. The blue line intersects, the blue is the MACD line, right? Our signal is the orange line. Here, the blue line intersects it from the bottom going up and price is going up. When the blue line crosses it going down, price starts going down. This is when we have it as for the convergent characteristic of it. So they work in hand here. They are reflective of each other. We're bullish, we're buying, our MACD crosses our signal from below going up, that's fine. Good. Strategy 2, predicting. So strategy 1 was predicting the trend using the MACD, right? And now we come with strategy 2, predicting the possibility of market reversal using MACD divergence. I want to stress on that. Our first one was identifying the trend. And we want to identify the trend using convergence. That means when the price is going up, or MACD going up. When the price is going down, or MACD is going down. This is us identifying and sticking with the trend. Now, strategy 2 says we are using it now to identify a market reversal. So to identify the market reversal, then we have to look at the divergent aspect. They're not working together. So when I am jumping, you're pointing down. When I stoop down, you're pointing up. That shows something isn't cutting, as we say sometimes. So another characteristic of MACD is divergence. You need to identify the divergence of the MACD line. From there, you can focus the possibility of price reversal. There are 2 basic types of MACD divergence, right? The MACD bullish divergence and the MACD bearish divergence. Remember, we are looking at trend reversal. We looked at bullish reversal patterns already, bearish reversal patterns. Now we are looking at the MACD bullish divergence, or we can say reversal because we're actually looking for a reversal in that case, and the bearish divergence. What is the MACD bullish divergence? Remember, bullish is always going up, right? We're looking for a buy. So the MACD bullish divergence appear, and if we go back to our previous lesson, if we're looking for a bullish reversal, that means we're looking for the price to reverse into a buy. It means that the market must be in what state? Let me hear you, somebody, to make sure you're not sleeping on me. In order for us to talk about a bullish reversal, for the market to reverse to go into a buy, what state must the market be in?
A downtrend.
It must be in a downtrend. It must be in a sell. So if we're talking about a bullish divergence, or we're looking for a bullish change, it means that the market is coming from a bearish direction, from a down, to get into a buy, right? So the bullish divergence appears when the price is in a downtrend. So we are in a downtrend now. We're waiting to see when the price is going to, direction is going to change. divergence appears between the price and the MACD indicator. That is, the price decreases, but the MACD indicator increases. Soon after, the price reverses from bearish to bullish. Let's see that in action. Look here. The price is going down, right? We are looking at divergence. They are opposite each other now. So price is going down, but our MACD, our lines are moving upwards. This is where the divergence aspect of it comes here. So it gives you an indication, no, something is about to happen, because the price is going down and our MACD is showing divergence, is showing the opposite. When the MACD is in the direction showing convergence, showing agreement with price, we know we are staying in the trend, right? So the very first thing you do when you have your MACD indicator is to determine whether or not it is showing convergence or divergence. If it is showing convergence, in other words, if when the price is going down, the MACD is going down, the MACD is saying, listen, stay in the trend. But in this case, when we have divergence, the market is going down, but our MACD is going up. It tells us very soon there's going to be a reversal in price. And look at this. Our MACD line crosses the signal line from below to head up. We get these powerful green colors here for that bearish change, for that bullish change here to go up. And soon after we have that here, look again, look at what's happening here. They rubbed each other for a while, and then we have it cutting again the signal line in an uptrend. And now it is following the trend. So understand this. One, we always trade with the trend. We trade in convergence when the market is moving in the direction of the MACD. That's when we trade. Whenever they're not in convergence, when they're in divergence, when they're showing opposite, it means that the trend is about to change. So we are waiting. So our trend, we are going down, and the MACD was going upwards. We had this little area here, but look at what's happening here now. Now that our MACD crosses the signal line above from below, we see now our trend starts going up in a bullish direction, and our MACD is also going up. Now we can enter that trade here. So divergence just indicates to us that the trend is about to change, possibly. That's why predicting the possibility of market reversal with MACD divergence. So once there is the divergence, it gives us an indication that the market is about to reverse. So we wait until we get the signal. And when we see the crossing of the line, the MACD line crosses the signal line, we know we're in for it, because now we start seeing convergence or agreement. MACD bearish divergence. Remember, bearish is going down or going for a sell. So for us to talk about bearish divergence, for us to talk about going for a sell, it must mean that we came from a buy or bullish or uptrend direction. So in order to change to go down, you must be coming up. So the bearish divergence appears when the price in an uptrend, right? Divergence appears between the price and the MACD indicator. So price is increasing, but the MACD is decreasing. Soon after, the price reverses from an uptrend to a downtrend. Let's see that in action. Look at what's going on here. The price is going up, but as the price is going up, our MACD shows divergence. Our MACD is going down. When these candles here, this histogram here should be green in support of what's going on, because the market is going up, it is showing red. It is telling you something is about to happen. The market is about to change direction, because our price is going up, but our MACD is going down. We have this little area here, but look at what's happening over here. Our MACD crosses our indicator right here. And soon after, right where it happens, we start seeing the price going down. Now we move from divergence, which is opposite, to convergence, conformity, because now they're working synchronously. The price is going down, MACD going down. We in our consolidation, we see that here. Price this side, you're going to make a little turn up. Look at what's happening here. Our MACD is moving in that direction here. But look at something on the chart again also. Look at where we have the cross, where the MACD crosses the signal line. And right where it crosses, look at that candle here. So this is a real-time as it gets indicator. It is not a lagging indicator. And why again? Because of the low values of the moving averages. This is why we are so spot on. If you were to change and put higher numbers for moving averages, we would not get that type of response. So this is why it is important here. So we are looking at the possibility of a reversal because we see divergence between the MACD and our pricing. So this is a possible reversal, pattern reversal, because remember, this is what the MACD is all about. It's an indicator, but that shows us trend and market condition when market is about to change the direction of a trend. Let's move on. Question, anyone? All right, no question. How, now that we understand, or now that we know about indicators and how they function, what they do, we need to know how we can use them in our trading. How to effectively trade Forex using the MACD indicator. Strategy 1. Trade Forex following the trend effectively with MACD indicator. Somebody is asking something? I thought I heard somebody. All right, good, right. So we trade following the trend effectively with indicator. So remember, our MACD is for us to use to follow the trend. And it also gives us a heads up, the trend is about to change. So wait for it to change so that you can follow the trend again. Right, so conditions. Because the MACD is such a real-time indicator, it is not suited for a very high time frame. So our condition is a 30 minutes or 1 hour candlestick chart. Remember, the two moving averages are the 12 and 26 for the MACD, and the 9 is our signal indicator. So in a 30 minutes or 1 hour Japanese candlestick, because of the accuracy at which it relates the current price trend, the current prices, this is why we can use them over a long period. So open a buy order with MACD as follows. When do we enter? We enter right after the MACD line crosses the signal line from below and opens up. So it's not just crossing the line is one of the aspects, but what is most important is after it crosses the line, they separate the line open, because it can hold the line for a long time, which means we're just consolidating. Our stop loss should be at the lowest price before it rebounded. And our take profit when the MACD line crosses the signal line from above. So the MACD tells us the entry and exit point of the trade. That's what it does. We use what we have done before to find our stop loss for that trade also. So let's see it in action. Good. So we have here, blue is our MACD line, orange is our signal line. There was no trade here. Look how long the blue and the orange are rubbing together. So there is no trade. Look at the MACD here. Look at the histogram right on the 0 line. No major activity. And look at our chart here. Our chart is showing consolidation. But look here. There was a little separation, and then we see our MACD line crossing our signal line from below. This is a signal for our entry point, and we enter on this candle. And we see we have this green here. because we enter for the buy. And this heavy green tells us there is a heavy movement in the market. So just as the MACD line crosses the signal line, we know we can enter. So we enter on this candle. Our stop loss is 1510 to 15 pips below the lowest previous one, which is going to be here. Our take profit now, as we just made mention, let our MACD tell us when the trend is getting out of the trend. Remember, it is an active indicator, not a lagging indicator. So you wouldn't lose major if you follow it. So we got in the entry when it crosses here, and we're waiting for when it crosses it on the other side for us to get out of the trade. And as the MACD crosses the signal line here, this is where we get out of the trade right here. This is our take profit level. So we would have gotten off right here. So we just use the MACD to enter and exit a trade. Right? That falls for a buy order. To open a sell order, our entry point is right after, remember we're selling it, so we're looking to go down. Right after the MACD line crosses the signal line from above and opens up. So when we were buying, we wanted the line to cross from below to go up. Now that we are selling, we want it to cross from on top to come down. So our entry point, right after the MACD line crosses the signal line from above and opens up. So the blue line crosses the red line, or the orange line, or the yellow line, whichever line we want to call it. The color can vary. Our stop loss, because we're going in a sell, will be at the highest price level before it fell back. And our take profit, right when the MACD crosses the signal line again from below to show that it is going back in a bullish uptrend. Let's see it in action. So look at what's going on here. Our prices are going up here. We have our signal line crossing, our MACD line crossing the signal line from below. What happened? Price starts going up all the way here. So this was a perfect entry for an up here, right? So price went all the way up. But here's what. They separated, and right where the MACD line crosses our signal line from on top and opens right away. It didn't rub the line as we see in the previous one here, and it opens. We know this is a signal for a sell. So it happened on this candle here. So we end up with sell on that candle. Look at this. Let's suppose we had entered on this candle here. Look what happened. The next candle, we wouldn't have lost our stop, get out of our stop loss. But if we wait for the next candle at the appropriate time, look, we got in at a higher rate, which means we collected more pips. So we wait for that candle to close here when it crosses, and we enter on this point here for a sell. And then as the market goes down, we have our convergence. We can see it here. The MACD is following the direction of price. But then we get to a stage right where the MACD line crosses the signal line from below to signify an uptrend here. We get out of the trade. So our take profit is right here. So we'd have gotten this low, but on the retracement, it would have cut us off right here. So this is how we do, how we get in and get out. The MACD cross the signal from on top, we enter the trade. It comes down and it crosses it from below to go back up, we exit the trade. That's how we use the MACD for this. Strategy 2, trade Forex using the divergence. So we are actually looking now for a trend change, a change in trend. With this trading strategy, the order's accuracy is higher. However, you will need more time to open an order. This is because the MACD divergence rarely appears. So most of the time, the convergence is what we're going to see. So if you're going to look for that here, the divergence doesn't show as often as others. But when you see the divergence, you know it has a high level of accuracy. What are the conditions? Just as the other one, a 30 minutes and a 1 hour candlestick pattern. When do we buy? We open a buy order when the MACD bullish divergence appears as follows. The entry point is when the MACD line and the signal line widen and point up. Once they start widening, we can enter. Our stop loss is at the lowest price level before it rebounds. And our take profit is when the MACD line crosses the signal line from above. So all this has been going on here, and we let the MACD tell us our entry and our exit points. Let's see it in action. So our market is going down here, but look at our MACD. It is not going downwards just as this is showing here. So this, they're in divergence. Look here, the price is going up, but our MACD is moving down. But something is happening here. So then we have here, the MACD crosses our signal line here, but we are waiting for the open up. It crosses it to show, yes, we're going up, but we are waiting for them to open up to confirm. And this area here is where they start separating, they start opening, so we get in at the trade here. And then as soon as the MACD crosses the signal line here, we know it is time for us to get out of the trade. So this is our take profit up here. We'd have gotten this high. In the event we didn't, once the price gets here, it would have closed off our trade. So we use the divergence to identify a change in trend, knowing where to get in and when to get out. Open sell order when the MACD bearish divergence appears as follows. So we're looking for the market downwards. Our entry point, when the MACD line and the signal line widen and heads down. Our stop loss is at the highest price level before price fell back. And our take profit again, we use the MACD. When the MACD line crosses from below, says that no, we're going back up. This is where we exit the trade. So let's see. Market is going up, or MACD is showing us all those things here. Now we have the MACD intersecting in our signal line, going downwards and opening right away. So we enter here. And the market going down, and the market is going down, and our MACD is reflective. They're showing convergence here. But look here, when the signal line decides, here's what, I want to cross the MACD line, decides I want to cross the signal line, this is where we exit. So we look and we see when they cross, yes, but when they start opening for us to make the directional bias of our trade. And we exit our trade when the opposite happens on the other side later on. So note, when using the MACD indicator in Forex trading, one, the MACD indicator is mainly used to determine a trend as well as a market trend reversal. So it is used to identify the trend, uptrend or downtrend, or the market is about to reverse into a downtrend or into an uptrend. That's what the main use of it. Two, it's also used to search for entry points with the highest accuracy. So for a note, we should combine the MACD with one or two other indicators. So there are other indicators that give you a certain signal. It might be okay to work along that with our MACD. MACD gives the most accurate signal when used on price charts with long time frames. With short time frame, signals can be misleading. Very crucial point, I'll explain why. Because of the length of the moving average, 9 and 12, it means that they're going to reflect price almost immediately. So there are times the market may do a reversal, or it may just do a retracement, not a reversal. It may just do a little retracement, but the moving average, because of the values, it is going to show up as though, here's what, it's time to get out of the trade. So they don't handle, one of the shortcomings of it, it doesn't handle immediate movements as it is so as some of the other indicators, right? So if we use charts with a long time frame, it tends to give us a little more accuracy. But because, as I said earlier, the nature of what we do and with trading and how we want to get in and out, we use it on the short time frame as indicative of when we want it to indicate to us, here's what the trend is about to change, or we're in an uptrend or we are in a downtrend. It's all about practice with this indicator. MACD is a very good trading tool that is trusted by many veteran traders. Experience this indicator today to have one more basic Forex trading skill. And this has brought us to the end of this indicator, MACD indicator. Question, any slide you want me to go over?
Not really. If you could just go over showing us not this slide, but on the real chart, the diversion thing again. On the chart you had, chart you had,
so we're gonna wait, right? So we're gonna go over all of the charts. Right. So this again is what the MACD indicator is about, this bottom portion. 2 lines and this histogram. The histogram, there is a thin line, a 0 line, and further away is greater value. Longer these bars are, it's reflective of the length of the candles, right? The darker they are, it shows bigger movements. During consolidation phase, it's sort of a grayed out. The MACD lines are 2 set of indicators, 2 set of moving averages. The blue line, which is a MACD line, is at 12 and 26. So that tells you how recent they are. We're taking 12 candlesticks and we're taking 26 candlesticks. So let me explain this, how we come up with a value for this. Remember, if we're just working with one moving average of 12, it is going to take the average of the last 12 candles and show that average for you. Then if we have 26, it is going to count the last 26 candles and give you the average of them. But in this case here, it is finding the average of the last 12 candlestick, finding the average of the last 26 candlestick, and still finding the average of these 2 numbers. So let's suppose the average of the last 12 candlestick was 7. And the average of the last 26 candles was, let's say, 9. That's 2 numbers. It is going to add 7 and 9. That's 16, and it's going to give you 8 as the average. So even greater accuracy. We find the average of these 12 last candles, the average of these last 26, and we find the average of these 2 numbers. This is what adds to the accuracy and makes it such a real-time indicator. And then we have the signal line, which is taking the average of the last 9 candles. So it's going to be highly responsive, more responsive than even these 2. This is why we have the signal line all over the place, because it reacts with price in real time. We have 2 things to look at: divergence and convergence. Convergence simply means our MACD line is moving in the direction of price. That's what convergence means. Divergent means it is not moving in the direction of price. So let's look at this chart here. Price is going up. Look at our MACD. Our MACD lines, they are going up. That means they are showing convergence. They are working together. Our MACD, our price is going down here. Look at our MACD. Our MACD is also going down. Look, our MACD blue line crosses the signal line for down, and the trend is going down. So they're working in harmony. So as long as you're seeing this, you're seeing in the trade. Imagine you're in this trade here, where the MACD crosses the signal for up. Fine, you stay in the trade, but then you're going to get out when the MACD crosses it for down right here, you're going to get out of the trade right there. They're showing convergence, they're working together. Market moving up, or MACD is moving up. MACD going down because the market is going down. That's showing convergence. They are working together. Let's look at this one here. Remember, the MACD is really a trend trading indicator. So when they are working together in convergence, we are staying in the trend. However, when we see divergence, that means they are working, they are reacting against each other, opposite direction. It tells us that the trend is about to change. Divergence says the trend is about to change, so monitor it, and when the trend changes, we get into convergence and we are trading again. What do I mean? If we look here, we see the market going down, but look at our MACD. Our MACD is crossing up. Our MACD is crossing our signal up. But prices are going down and our MACD is going up. So it is showing conflict here. It is showing divergence. So we wait to see what's going to happen. Now we see our MACD is crossing up. It's crossing our signal line up here. It opened for a while, and when it opened, we went into a buy. But look at what happened in here. We got into a little retracement here. So it came back closer to the line. So here's what. In the direction when you're going in a convergence atmosphere, every time the MACD line touches the signal line, it is a good point of entry. Let's prove it. So it cut from below to go up here. It was an entry point. It went up. There was a little retracement. Fine. But look at here. Our MACD touches our signal line here. This is a perfect point for entry. We go up and price is fine. There was a little retracement here. Although they're working in convergence because they're going in the same direction. But look at this here. There's a little retracement here. And the MACD line touches our signal line here. This is another point of entry. You see, look at what happens now. The market moves all the way up. Look again, a little retracement down here. Our MACD touches our signal line. It didn't cross it. It touched it here. This is also another point of entry. And the market went up. Finally, when our MACD crosses downwards, look at what happens here. So they're in convergence here because we're going up with the price, we're going up with the MACD. They are in divergence over here because we're going down with price, but up with the MACD. So divergence tells us the trend is about to change. So if you catch it around here, you wait until you get the confirmation for the change of trend. This is what this is saying here. Let's look at another chart here now, this one. So we're looking at a market reversal. So this one here, we are looking for a reversal, but a bullish reversal, because we are coming from a bearish direction for the trend to change upwards. That's the bullish here. Now we are looking at the bearish. So for us to have a bearish reversal, it means that we are coming from a bullish into a bearish. Are you hearing me still? I just saw a little flash that my internet connection is unstable. Am I still being heard?
Yeah, we're hearing you. Just
Yes, we're hearing you.
Okay,
not very much.
Yeah, the internet just crappy for the last 2 days. Right. So we are talking here now of a bearish reversal. So to move down into a sell, into a bearish direction, we must be coming from an upward, a bullish here. So look at what's going on here. The market is going up, but look at our MACD. Our MACD is crossing our signal, showing down. So because it shows confusion, it shows divergence, we are waiting because we have an indication that the trend is about to change. And this is so accurate, but mind you, seldomly we would have those being identified, right? They don't happen as often as the convergence. The divergence aren't so prevalent. So when we see it, we know we can put a pot on the fire, things are going to work. So market going up, MACD is going down. We wait, Our MACD crosses our signal for up, but it crosses it for down. And we have that whole area of consolidation here. But then we see right at this point here, our MACD crosses the signal from up to down to go down, and they start opening, and look what happened. Our trend is going down and our MACD is going down. We have a little consolidation and our MACD starts consolidating. So they're working now in convergence here. Over here, they were divergence. They were opposite each other, but now they're working together. So we are always trading when they are in convergence, when they're working together. But whenever we see them in divergence, we know because a trend change is about to happen. Let's see this one here. So for entry here now again, so we're trading with the trend, right? Here, we're looking at it here. We are in convergence here. So look at what's going on. All the time they're robbing each other. We're not trading at all. We need to see them fan out. We need to see them open out. The wider they open out the MACD and the signal line, the wider they are, the better it is, the surer we are in the trend. And here we see our MACD cuts our signal line from below to go up. We enter all the way and we're waiting until we see it cut again to go down. And here it cuts to go down, we get out of the trade. We know the principle already for take profit and for stop loss. This is our entry and our exit here in this bullish market. It happens here after it cuts down for a while. We had this slight little retracement here, but look what happens right in the end here. As soon as our MACD crosses our signal line, look at some big candles start being formed here. Again, back up that is going. Let's see this one here. Right. So we have, look at the market here. Look at the market going here. It's going up. Look at our MACD and our signal here. And then after they widen out here, we have some consolidation taking place. Our MACD crosses our signal line for down here, and this gives us our entry point. So this divergence here shows the market is about to change. Here we have the confirmation. And as we start going down, our MACD is going down. We wait now that the MACD is crossing the signal from below to go up, we exit the trade. So we know we are using the MACD to determine our entry and our exit. This is our divergence here. Our market is going down, but look at what's happening. Our MACD is not showing, is not reflective of what is happening here. But then we see the MACD crosses our signal here. We are waiting for it to fan out, to open out. And when it starts opening out here now, we take our entry because it opens. But then when it closes after and our MACD crosses downwards our signal, we know it is time to exit the trade. And this is the same principle here. So basically, our signal is the crossing of the MACD and the signal line. Once we can identify this, we know at the time we should enter the trade. And once we enter the trade using that, we monitor it. And whenever we see the opposite happens, the crossing takes place in the opposite direction, it indicates to us it is time to get out of this trade. So we are always trading with the trend. However, even in trading with the trend, there are times we're going to identify reversal and we get out, we wait until the reversal is done and the market starts moving in our direction again, we can enter the market. So this in a nutshell is the indicator, MACD indicator. It's quite a simple one, but it is very, very powerful, especially because of the real-timeness, if there is such a word, of the data that we're getting. It is not data that has been too old there, but our moving averages are very current. And we take those into consideration to create that indicator. Question, comment.
Mr. Paul, you can explain the short term. I think you mentioned earlier something about the real time.
Right, good. Okay, right. So let's go back and let's do that. Yeah, I know where you're coming from. Good. When we did moving averages, and this is why we did the moving average before we did the MACD. So let's break it down, not just for you, but for others to see how we can make it simpler. 5 children in a class, we do tests. Whatever the scores they get, various scores, it added up to 40. All the scores together added up to 40. It means that the average is 40 divided by 5, which is 8. In another session, we may have 30 people in a class, or let's say we have 20 people in a class, and the cumulative score together is 40, then the average of the class is 2. You know, there are times politicians use numbers or they use statistics conveniently. They may not lie by the words, but the intent may be a lie, because at times they can quote you numbers, value, or when it suits them, they can quote you percentage. Again, they may not be lying on the numbers, but it is a lie because they're trying to trick you, use it conveniently. So our moving average of 12 says, let's work with this candle, this long red candle here. Count back 12 candles at the rate, at the price at which they close. So let's suppose that this rate here is 1, 1.1, 1.2, 1.3, 1.4, 1.5, 1.6. It says come back 12 candles, and whatever price they close at, give me the average of it. That's what a moving average of 12 is all about. Come back the last 12 candles at whatever price they all closed at, and give me the average price. So this one closed at 1, and the next one closed at 1.1, and 1.2, and 1.3, and 1.4. And cumulatively, when you look at the close of all of them, you add them together, and they close at, let's say, 36. Because we were counting 12 candles, then our moving average here would be 336 divided by 12, because the close of the 12 candles total 36, and we find in the average. As opposed to a moving average of 26 says, go back and count 26 candles for me and give me the moving average. So that's 2 lines for 2 different moving average. It would be nice to see some simple moving average at 12 alongside the 26. There is a vast difference between them. But here's what. Now we have the 2 extreme moving average. Give me, like in simple mathematics, what we may say, give me the median. I want to work with the middle number. So you have the moving average of the last 12 candles. You have the moving average of the last 26 candles. Those are 2 values. Give me the average of these 2 values now. So I'm going all this to say that because we aren't looking at a lot of candles, the details we have here is very, very current. So let's suppose that these candles were 1 hour candles, right? Whatever happened on this candle over here, which might be about 5 days ago, is not so important for us because we're trading right now. So a moving average of 40, of 60, of 100 is too much old data for us for today. So this is why when we have these small numbers, it just went back just a couple hours. So this is why it is so effective. So this chart, when you look at them, they're almost in real time because they don't consider all this old data behind here. I don't interested in this data here. That's too old for me. Give me from here to come here, the most current data. So you go to buy a vehicle from somebody and they tell you, well, you say, well, I have to travel. So when I come back, I'm going to buy the vehicle. So just before you travel, you went and test drive the vehicle and all this thing. And then they say, watch, I want 40,000 for the vehicle. That's fine. I agree. I'm going to pay you 40,000. I'll go in America for a week. And when I come back, we go buy the vehicle. It so happened that you stay in America for 6 months. When you come back after 6 months, the person had to be crazy to expect 40,000 still, because they drove it for 6 months. 6 months must have taken off some money from the price of it. So whatever it was worth 6 months ago has nothing to do with you, with the price you want to pay them today. As opposed to somebody who went in America for 4 days and they come back, what do we say 40,000 stand? Because not much has happened within that time. It's the same kind of scenario as this year. We are more concerned with what is happening currently. So because these values of the moving average are so close, they are so near to the current rate, or the current price we have here, we have them moving in real time. So this is why using the MACD with these values here, when you're trading, you have to trade a short period, a short time frame. You can't go on the daily and say you want to trade with the MACD, because bearing in mind, the information it pulls is just a couple hours old. So this is why it says ideally we trade on the 30 minutes and the 1 hour, because the current data that this MACD histogram and the chart and thing is showing here is more relevant for the last hour or half hour. So this is why I say you use it a shorter time frame, because here's what, this is the hour. And remember, you are not setting, as we use other indicators, when you get into the trade, even before the trade plays out, you set your stop loss and your take profit. With the MACD, we set our stop loss, but we don't know what our TP is going to be. Why? Because we are waiting for the MACD to tell us when the trend is changing. This is why this has to be done in a short time frame. So I have some time to trade. I'm going to do that here. Fine. We're going to use the MACD. Why? Because, let me show you why. Let's pull one of them that has data here. Let's get one that shows you where to enter and where to exit the trade. Good, right? So this one, for example. So we know where our stop loss is, and because we know where we're entering. Our MACD crosses the signal line from below to go up, so we know that it's a buy. We enter the trade here on this candle, and we know our stop loss is lower, 15 pips lower than that here. But where our take profit is, we aren't putting in that take profit here yet. We don't know what that is. We are waiting for our MACD line to cross. So if the MACD line right here just decided crossing here, we exit in the trade right here. If we decide to cross here, we exit in the trade right here. So we have to monitor it. And when we realize it starts crossing now, then we decide this is where I'm exiting the trade. If you want, you can set your TP at any level. But if you want to maximize, you let the MACD tells you. So imagine you're watching this on a daily. How much this thing can happen any amount of time or any time it happens. So you're going to realize you might make money, but then you're going to lose all the money that you make because you have the wrong time frame. This is why you use the short time frame. So you just are busy in and out. And all because of the value of the moving average. So let me stretch your question now. What if I don't have all this time to sit and watch it here? Because I have to work, I have to do this, I have to do that here. And you see, well, we use this in a short time frame. The mere fact that we did moving averages, it now tells you, here's what. Our MACD come with 12 and 26. I don't have this time, you know. I'm a more long-term trader. I may want to trade on the 4 hour or maybe on the daily. Then you can manipulate your values inside here. I may change 12 to 40 and 26 to 70, which means now I'm in a better position to trade on a longer time frame. Tell me you understand. If you don't, we can go it over.
Yes, I understand. I understand.
Yeah. So because of this value of the moving average, we have to use a short time frame. So when you master moving average and you understand moving average, you can make your own MACD configuration to suit your style of trading. So if you decide, listen, I am trading on the daily chart because I want to maximize when trend changes, it therefore means if I'm trading on the daily, so okay, simple. I'm trading on the 1 hour and I'm counting back 12 candles because that's what means a lot for me. So because I'm trading on the 4 hours, maybe about 30 candles may do. So I may change this first value to 30. I'm trading on the daily. So if I'm trading on the daily, it means I might be in a trade for a whole month or 2 months. I need more data to go back. So I may change this value to 140 and change this value to maybe 200. This value 9, I may change it to 45, thereabout, because I'm now using the daily to trade, and then your MACD is going to be effective. But you cannot use these values here for this higher time frame because of the, how should I say, the recency of the data that they reflect. These values here reflect recent data. And what makes it even more recent is because it's a combination of these two. A moving average of 12 by itself counts back 12 candles and gives you the average. A moving average of 26 gives you the average of the last 26 candles. But when we combine them, after we find the average of each of these numbers, we find the average of the two numbers. So it still pulls it down even more to give you greater accuracy. This is why with these values here, we use it on the 1 hour, the 30 minutes, and so we use it, and so when we have time to spare, we can actually do that. The beauty, however, is that you can open your trading your trading platform, your MetaTrader, and you can have one of the trading windows open with this MACD. You can have another window open with a MACD of different value based on what you're trading. So I'm trading on the 1 hour. I have this here. I have another tab with another pair. I'm trading on the 4 hours with a different value. I'm trading on the daily. So you can have multiple windows with multiple MACD values for the indicator based on your trading style. However, the MACD is very, 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 very efficient and effective in terms of telling you, listen, you could stay in the trade still, or the trend is about to change, or I think you should get off. Or you can even use that to make a buy and to make a sell. Here, he crosses it, you know, okay, I'm going in for a buy. He crosses it down, I'm getting out, I want to take a sell because I'm waiting. Why? Because it is real time. Look here, he crosses it up, so I get in for a buy. Here, look here, he crosses it down, I'm getting in for a sell, and I'm waiting. He get close to rubbing it, maybe I should get out, but he ain't cross it here, so I go jam it still. You touch it, you touch it, you touch it here. And then you realize it's still separate. So some person would have gotten out here, but because you realize it didn't cross it, you stayed in the trade still, and look at how further down it came. Whereas you would have gotten out up here, you get it a little lower down here. So you can use the MACD on your currency alone, and you're on the trend up and down, and you're riding it with the MACD just as good. You know, there is an indicator that's called a shock indicator, very, very effective, and it works as the MACD. Shock is above the water, we're buying. Shock goes down below the water, we're selling, and we're staying as long as the shock is below the water. Shock comes up for air, we buy. Shock stays up and it's breathing, we still buy. Shock is about to go back down, it's the same principle. So the MACD is a simple one we can use now for our trading strategy. We can use that MACD and we can ride it just by looking at those, following those values. I hope it's a bit clearer now with the explanation.
Yes,
Yes, it is. Yes, it is.
definitely. It is.
So there are a lot of indicators that we have done, and there are others that we have to do. But of all those here, if you work with the MACD, it is simple, it is very, very accurate. The MACD is a very good indicator that you can use. And the whole thing about it is just saying, okay, right, let me learn this indicator, let me learn this indicator. Because the beauty about it, with trading here, if you get a good signal, beta convergence or divergence on one pair, Euro US, GBP USD, just on one pair, and the signal is good, you can do 5, 10 trades on that one pair, as opposed to somebody trading 10 different currencies. So if you find a good trade on one pair, you do multiple buys or sell on that, which, because you're guaranteed that it's moving in that direction, as opposed to risking 7 or 8 various pairs at the same time. So you see, you know what? Let me take this MACD and I'm going to walk this MACD. I'm going to learn this MACD on a pair, Euro-US, and I'm watching it and monitoring it here. I try it first and it works. I try a little 10 cents here and it works here, and then you realize, okay, fine. You know what? I'm going to do 4 10 cents or 5 10 cents, which is the same as 50 cents trade you're doing here. But you can do all these multiple trades. And when you do these multiple trades, it accumulates quite a lot, as opposed to wanting to trade 7 or 8 or 10 different currency pair at the same time. Because some move much faster than others. But the MACD is a good indication, a good indicator that we can use to know the direction of the trend, how long we're staying in the trend, when a possible reversal is going to come, and when the reversal comes. This is how accurate the MACD indicator is. Very, very good for us for trading. All right, any other question, anything that we want cleared up?
No, it was pretty simple, at least for me. And it's just about going to practice and get used to it.
Yeah, it is a simple tool, very, very simple, but very, very effective. Of all those there, this is why when you install MetaTrader, any of the MetaTrader 4 or 5, they normally give you like 4 different, they give you 4 windows. MACD comes default in one of the windows. So once you install MetaTrader, the MACD comes with it. And one of the reasons why, because of the accuracy and the effectiveness of it. This, I think, is about the only, I'm not sure if there are other indicators that come with just the default installation, but I'm certain that with the default installation, MACD is one of those that comes with it because of the simplicity and accuracy of the indicator. So you can do proper trades just using the MACD. So yes, you have a small account and you say, okay, I need to look for some trades and look for some trades. Imagine you have 7 trades running, 2 trades in good profit and the next 5 trading loss. It would have been better for that 2 trades here if you had 6 or 7 trades running in that same currency pair. So it's not just about the amount of trades you have. You don't always have to do a lot of trades within the same pair, because if that pair goes bad and it reverses, then you lose all your trades. But once you use those indicators and you catch the market effectively with that indicator, smooth sailing for you. Like a submarine, you're staying down there, you don't even have to come up for air. So don't try to say, okay, today I will try this one and then I will try that one. The whole thing about trading is getting, and what we're teaching you here is for you eventually to develop your own strategy. You have to develop what works for you. So we're going to be doing indicator after indicator. You don't have to use all of them. You just know that they exist. But you can find one, and here's what I'm going to work this one and master it. Not because you lose on it today, I will change it to another one. You have to be consistent and persistent. The MACD is a good starting point. I'm going to work the MACD. I'm going to study the MACD. I'm going to try it until I master it, because the MACD gives you that kind of quick response that you need. And you stick to it, and you're good to go. Trading 3, 4, 5 trades on that one pair, and you'll get off. You don't have to close all of them at the same time. While the market start going, and you make a 30 pips in one, you close it. The next one go up to 50 pips, you close it. And so, likewise. That's how it works. So you don't have to set all of them at the TP at the same place. You just keep adding to it, and that's how it goes. So if nothing else, it was a short session. The time went by really quickly, about maybe about 18 minutes thereabout. I'm going to post the video, upload the video on the website, right? Normally, Mr. Jack will just send it in on the chat. Yeah, I'm going to upload the video and we're going to put it on the chat. I'll also, once I upload it, I'm going to send the link. I'm going to send the link in the chat, but I'm going to upload it on the website. So you can feel free to go back and look at it again. So thanks again for having me here tonight. And I wish you a good night.
Thank you.
Until
Good night.
next Zoom again. All right.
Thank you.
Good night, everyone.
Okay.
Night, everybody.